first rates will just start coming up on your screen now. It's a decent start, guys. It's a decent start, decent market breadth, decent market open, and the stocks are bouncing back after yesterday's collateral damage. So let's look at first, for me, the talking point really could be banks and then IT, as always. So banks are off to a decent start, IT is off to a decent start, and ahead of numbers, TCS is showing signs of modest stability. Now let's move from there and talk about the crude beneficiaries. If crude goes down, which are the companies which would benefit? Number one would be Indigo, then HPCL, BPCL, ONGC would actually see a cut, but Interglobe Aviation is gaining some weight, and I think it's visible there. Nomura report on pharma focus on companies which have a chronic portfolio that would include Eris, Lupin, Sun, Cipla. Those stocks are well in the green right now. But it's the breadth of the market which I want to talk about, which I think is meaningfully better than what we saw yesterday. So it's a good start, Aisha. It looks like what happened, or what's happening in Israel, markets are saying just ignore and move on.
Yeah, as they always do, tide over any wall of worry or war, almost inching into that 19,600 print as we speak right now. Let's check in on what IT as a pack is up to. Remember yesterday, the resilience was clearly evident in the IT pack solely, actually. So let's revisit the likes of HCL Technologies and TCS ahead of its numbers tomorrow. That stock will just come up for you on your screens. But across the board, I can see green, M&M, Tata Steel, Tata Motors, Hero MotoCorp, ONGC, Bajaj Finance. About a 1 to 0.5% is the kind of move that you're seeing pretty much across the board. Genius Power, look out for that stock, that sizable order in excess of 3,000 crore rupees that they've won for smart prepaid meters. That could gap up today, 5% higher for Genius as we speak right now. Mazagon Dock, they've signed the LOI with a European client. That again is going to be a big mover, perhaps 6% higher for Mazagon as we speak. Phoenix Mills, wherein they've indicated as part of their second quarter update that retail consumption has seen an uptick of 20% on a year-on-year basis, 1.5% higher for Phoenix Mills as well. And then Escorts Kubota, wherein there is a significant upgrade to buy and a price target uptick as well from DAM Capital. That's another stock which is holding up 3.5% higher as we speak right now. That said, let's also check in on what HDFC Bank, Reliance Industries, the kingpins are up to in trade, and whether they are cushioning the index as we speak right now or not. 1525 for HDFC Bank, Reliance marginally higher, just struggling around that 2300 odd level. Kunal, the first rates that you're bunching in.
I think looks attractive. We are back again above that 19600 mark on the spot Nifty. The premiums for the Bank Nifty are slightly higher, so I think from 100 point to 125, that's encouraging. In terms of opening trade, real estate is something which looks attractive as a sector, and DLF is something which I would pick from the pack. The stock is trading very close towards the previous breakout point of 535, 540. So it looks as a very attractive proposition from current levels.
Right, Naresh, what are the first trades that look attractive to you?
So playing it defensive, IndusInd Bank looks interesting from here on. Would add more on the way up above 1470 levels.
All right, Amit Sachdeva joins us. He's India equity strategist with HSBC. Let's connect with him and understand what their view is and what exactly are they indicating to their clients. Amit, good morning. Thank you for joining us. Amit, first let's understand what is your take on the geopolitical tensions which are happening in Israel. The way markets have been resilient, both local market and global markets, looks like markets are saying this is not Russia and Ukraine. I mean, this is very localized and it will unlikely to have a financial disruption.
I thank you so much, Nikunj, for having me here. Good morning to you all. I think, geopolitical situations are always interesting and also hard to predict, right? It's one thing can lead to another. So I'm not going to call that out, to be honest. But I think market obviously has taken a view that situation will be contained and would not spiral out of control, etc. So at least market has taken that view. My sense is that could probably be the fair view as well. But more importantly, India's context is very interesting because, India is coming from a place where we are outperforming region 3 years in a row. And that's what makes many people think that whether these rallies can continue. But I think we need to drill down into entire Goldilocks scenario of India, my sense is that two vulnerabilities for India. One is obviously geopolitical crisis. If it spirals out of control, then it might weigh on India's investment case, but also US bond yields have risen quite sharply, and that has seen some outflow as well. But if you look at the overall picture for India's Goldilocks, I would hazard a guess that based on the cycle work we have done for the last 20 years of market cycles, our view is that India is in a decisive bull run, and we are in the middle of it right now. So once, and I think it's fair to say that Indian market has that resilience, that once the bull market or context sets in, it doesn't go away that easily. So any sort of event such as near-term some crisis or bond yields going up, it tends to sort of have a short-term consolidation, which is very shallow, and then market goes up again. And the kind of evidence we are seeing today, this morning as well, is kind of that.
You're making a case that it's time to rotate out of mid-cap stocks and small-cap stocks into large-cap stocks. While there is merit based on valuation parameter, do you think flows and liquidity, in a sense, will be the restrictive factor because FIs are selling, they invest in large-cap stocks. HNIs are buying, they buy mid and small-cap stocks. Demat accounts are opening, well, buy large-cap stocks, they typically chase the momentum. So while there is a big, strong fundamental case for buying large caps and selling, buying large caps and selling mid caps, do you think in totality it may not play out?
No, it's a great question, and I think market will continue to sort of wager on that. So my sense is that look at where we are in the cycle. If you reflect all the bull runs of the past, you'll find that the mid caps tends to have a run of 1.4x the market run. And bull runs are, mid cap rallies are a symptom of those bull runs. And this market is no different. It is typical of that bull run, and we are decisively in a bull run. Now, that run is about 1.8x today, so which is slightly larger. So in some sense, small and mid caps are running ahead of the overall market by a wide margin. Now, it also leaves valuations of large caps relatively more tenable and reasonable. And hence that feeds into India's attractiveness. The domestic flows, which obviously are very resilient, and FI flows have become slightly negative. But we argue that FI flows, which has turned negative on events such as US bond yields, is a very short-term phenomenon. We are looking at, last year's flows about minus 17 billion. So we are sitting on a very low base of FI flows. In fact, if you go back 2021 and 22, we have seen about 34 billion outflow. So for FI flows point of view, we are actually in a very benign base. So some shortfall in FI outflow is not an indication of that it's a sustained sort of outflow that can happen. So that's point number one. My sense is that FI outflows are very short term and probably would rebound as we go along in the months, as the earnings shape up and other things. Mid cap rallies is just a bit of a caution. Two reasons. One, mid-cap breadth is about 93%. Now, 93% breadth, we've seen that it sort of doesn't sustain for very long term. So it's a bit of a worry that one need to put a caution into it. It is also true that for the entire spread of bull runs, mid-caps and small caps tend to outperform. Right? It is not a case where they tend to sort of underperform as we approach the bull run end, etc. No, they continue to do well. But what happens is market learns from the past. And we see the evidence today that incremental money is coming in the small cap and medium mid-cap scheme because that's what outperforms and everybody knows it. But it generates its own excesses. To avoid some amount of those excesses, one has to be very careful. We also see some good mid-cap ideas, but also we need to be careful that we don't overpay and buy the excessive momentum there. So element of caution built in is very prudent at this point. And that's what we want to say, that imminently some large cap become very appealing, and as FI flow returns, there could be rallies expected there as well. Because we are in a bull run and where large cap and mid cap both can perform very well. One has lagged behind, will catch up. One has overrun, may have take a breather sometime, but then both have a potential to participate in the bull run.
That's quite interesting.
I hope that answers your question.
Yes, it does. And, brings up many more questions from what you just spoke about, Amit, as well. What would have to change on ground, or what are the cues that triggers that'll make FIIs come back to India equities? Because I was just looking at the data. This is one of the largest selling sprees that we have seen in the recent history, a consecutive 14 days of a sell-off from FIIs. What would have to change on ground for them to come back? And would it only be a function of the way the US yield pans out?
It's largely that factor, to be honest. See, if you look at FI flows, and if you have to put that in the context of bull runs, we are about 0.6% of the market cap. Last 12 month FI inflow. So every time you look at FI inflows, you have to look at accumulated flow of last 12 months, because you may see some incessant flows in the last 6 months, assuming that is the massive inflow that's already come. But it's true because the base is very, very benign. So we're at about 0.6% of market cap, which is way below the bull run averages at 1.7 and perhaps 3% of bull run peak. So in some sense, the flow, the base is extremely benign. We've seen large outflows last year, to be honest, minus 17 billion to be precise. So we are sitting in we've just seen few months of inflows, and that has turned negative, and that to minus 2 billion in August and September, and some negative in October as we beginning. But it's largely driven by uncertainties around global events, but also US bond yield rising, and there's a snap reaction on India as well. If, for example, but that has a short-lived reaction. So if earnings in India are holding up, we're not seeing any major downgrades. Crude, which was a worry for me, to be honest, when it was touching 95, it was going 100. I was worrying that that might weigh, but that has gone back to 83, 84. So in some sense, crude is still behaving in a normal zone. As Nikunj rightly points out, the long-term trajectory for crude is downwards, not upwards. So it is not a fear. Even inflation in India tends to be sort of moving downwards, and RBI's view would be also that it is tameable, and looking at 5%, and next year 4.3 even for next year 1 year view. So in some sense, inflation is not a worry as well. So I think India's Goldilocks scenario, which is built up of earnings, stable macro, stable inflation, to FI flows, valuation, breadth, everything put together, large part of Goldilocks is positive. Some externality are negative, which gets priced in a short phases like that. So I would probably think that if earnings are delivered and not major downgrade cuts are happening, we have a case that it's a case for rebound. We should not also forget that while India may have outperformed in 3 years in a row, but 22 was a negative year of performance. We were down minus 10 approximately. And in 22, we have performed, but we are just up 9% on a full year basis. It's just a March rally. So valuation is also okay. So I don't see any reason, given the stable growth macro and where the world is today, India continues to be a very attractive destination for FIs. And that is not going to go away with 1 month of small short-term volatility or event. That's I think the larger game is set. If you look at the longer picture, what gives you confidence that India should do well? Look at last 20 years. We have 14% CAGR, but only 4 times in probably 20 years, India has delivered negative returns in local currency. Is seen as a more structural market. But another factor that has worked in India's favor is that when you survive crisis, the resilience is proven. For example, we have seen 2 successive crises, like COVID crisis, India stood out. Another test of India was how it will behave when Ukraine war has happened, what is grappling with recession fears and inflation. Look at India. Another point was proven that India is far more resilient than it was ever in the past. That also has led to, I would say, India's flow being more structural than tactical and cyclical. I hope that answers, but it's again anybody's guess. I feel that the structural appeal of India is on a massive rise.
Oh, you're right. And you've given those compelling examples as well to support it. I'd also, Morning, firstly like to get in your views when it comes to individual sectors, and in particular, the opportunity within the pharma space. No doubt, we have already seen that run play out. So my question is, do you think that even right now it's a compelling opportunity to look at pharma, or do you think that it's perhaps to a certain extent run its course?
In a sectoral framework, what we have put together in the last published report, which breaks sectors down into sort of 2 dimensions, how optimistic you are and how business dynamics are. So pharma I would put it in a bracket where business dynamics are also turning positive, but investors have also started to run a little bit positive. But it's still in a very favorable zone that, given the underperformance of the past, pharma is still very favorable. So we continue to like the sector in a sectoral framework. Another sector which stands out for us is financials, which has some opportunities which could be very compelling as well. If we were to look at broader framework, but if we were to believe that market would turn risk on, which means that bull runs will continue and sector rotation will continue, we continue to see IT has an candidate for re-rating as well, even though the growth obviously in the near term is challenged, but incremental positive news can also benefit the sector. We see positive momentum for autos as well. We see positive momentum for consumer discretionaries too. So in some sense, those sectors tend to look favorable in our view. We are slightly cautious on consumer staples there because that sits unfavorably in our framework where dynamics are turning a bit negative, or at least investors already discount a lot of these expectations of near-term margins and growth, etc. So maybe that area we are a bit cautious there.
All right, really appreciate your time, Amit. So glad you could join us, and certainly hope to see much more of you going forward.
Thank you, Nikunj. Thank you for having me here. I hope this helps.
Thank you very much. Indeed, it was quite helpful, and I'm sure our viewers will take note of that why there is a strong appeal when it comes to the macro positioning of India. Siddharth Bhaiya joins us now, and let's connect with him to understand that at a time when macros are looking great, where is he shopping and how is he churning his portfolio in the micros? When we spoke to him last time, he said, I don't own financials, I don't like IT. So then I asked him, what do you own? So let's take that conversation forward. So Siddharth, good to have you back. Thank you for joining us.
Hi, good morning, Nikunj. Good morning, Aisha.
What's been your portfolio strategy of late? I mean, this is a market where if you bought the right stocks, you're actually making money like bandits.
I think nothing much has changed, to be honest with you, Nikunj.
Why has nothing changed? I mean, the stock prices have changed for sure.
Yes, stock prices have changed.
Okay. So how are you positioning yourself in terms of some of the ideas which we discussed? For example, last time you were underweight financials. You said
Correct.
that's a concentrated trade. And for me, if I have to run a PMS scheme, if I do what others are doing, then how do I differentiate? And that strategy has worked for you. So have your top 3-4 holdings changed in last 3 months?
No, not actually. And I think the financials trade has kind of played off well. If you look at it, financials have underperformed and they continue to remain at risk with the US interest rates going up. And domestically also the liquidity has now become tighter from a surplus of nearly 2 lakh crores, 3 lakh crores. We're now at a neutral liquidity as far as domestically we are concerned. So we see interest rates going up in India as well. The yield gap between US and India has come down, has shrunk massively. So I think financials will remain at risk. I see both deposit rates and lending rates going up. So yes, I would still be underweight financials.
You took a big bet in names like Avanti, Apar, all of them were very differentiated in mid-cap stocks. Where are you finding this opportunity in this market where you're not looking at what's happening to interest rates, you're not looking at the underlying tone and tonality of what is happening to the US Fed, but you're looking at the proposition of earnings which some of the companies have to offer? Where are you picking your spots right now?
See, again, as I said, the opportunities right now are far less and far few between than say a couple of years back right now. And I think I see a little bit of fatigue, Nikunj, again in the small and mid cap rally as well. Right, 6 months, we are now approximately 40% up in the small cap and mid cap space. After such a massive run, either you should have a consolidation or a little bit of a dip. So while long-term structural story looks good as far as India is concerned, short-term, I personally would be a little cautious in deploying fresh capital.
Okay, so does that mean, Siddharth, that you book out and get some profits off the table when it comes to small and mid caps, deploy that to large caps, or just sit on cash and keep the powder dry?
So we are Aisha, very long-term investors. So, the stocks that Nikunj mentioned, we've been holding for 7, 8, 10 years now. So that doesn't change our view. The only thing is we would probably, if we were to deploy fresh capital, we would look for better rates, maybe a slight dip or a slight consolidation or an improvement in the geopolitical or the macro front.
You've spoken about how the small caps being riskier than large caps is a myth. So can you elaborate a little bit more as to how exactly investors should be approaching the broader markets?
Again, as I said, I don't necessarily say that. Or I also go on and say that 90% of small cap is actually junk. So both statements hold true. I've seen enough large caps become penny stocks over a period of time. And majority of the large caps today that we see were small caps maybe 25, 30 years back. So it has to be a company specific approach, right? Capitalization doesn't matter. At the end of the day, what also matters is the revenues, the profitability, the growth rates that the companies are exhibiting, and the potential future from a long-term perspective. So yes, that is what we focus on, right? Our focus usually is very, very long-term, and we want to buy large companies at small market capitalization.
So that, I'm quite intrigued by why is it that it's a blanket call on banks? I mean, are all banks bad and are they all not going to make money? PSBs surely have given you a good return. I understand that large cap, private banking names have not performed, not gone anywhere. But why are you so off from banks?
So there are two ways to play banks,
Sure.
right? One is, okay, the banks itself, if the economy has to do well, typically banks will, as an overall, this will grow at 15 to 18% kind of a number. The other way is to look at where the flow of credit is going. And we tend to focus on industries where bank credit is flowing, and which we see over the last couple of years has gone away from consumerism to infrastructure to capital goods. So while the entire 20s, from 2010 to 2020 was more about consumerism, bank credit flowing to the consumer, I think the next 10 years and the last couple of years and probably the next 7, 8, 10 years is going to be about credit flowing to the government, credit flowing for B2B, corporate credit, infrastructure growth, capital goods. So these are the sectors we feel credit is going to go to, and we're playing banks through that route. Obviously, we do own a couple of B2B financial institutions as well, which are into long-term infrastructure financing, but nothing as far as banks is concerned.
Amongst the list of sectoral bets, I'm curious as to what the outlook is when it comes to the media space, because not very many market experts, tend to look at this sector quite closely. So what exactly is the rationale? Is it the overall ad rates picking up? What exactly is, pulling you towards this space?
See, I open the newspapers and today I see 6 to 8 pages of advertisement on the front page. And particularly with all the IPO companies coming up. So whether it is print or whether it is digital or whether it is television, I think the valuations have corrected quite a bit. And they were kind of factoring in bankruptcy valuations, whereas their balance sheets were pretty healthy. At some point in time, say a year back, some of these companies had more than 50% net cash on their balance sheet. And they were available at 3 and 4 P multiple. Today, with elections coming in, ad rates are going to go up. With such huge IPO market, you're seeing demand for advertisement, even in newspapers and print, going up significantly, right? So, and with the Cricket World Cup also coming in. So yes, the valuations were attractive, and I think the growth has come back in, and hopefully the stocks will continue to re-rate.
Whatever you were just expressing in terms of thoughts, we are flashing it on the ticker. And we are flashing that short-term moves in the market do not derail the long-term story. You don't like financials, but the current portfolio holding which you have right now, you're happy to own them for next couple of years. So can I say, and this is public information, Gujarat Ambuja Exports, Deepak Fertilizer, Apar Industries, Technocraft Industries, you see visibility for next 3 to 5 years in some of these names?
So Nikunj, to be honest with you, you never see visibility beyond a couple of quarters. Right? Even those couple of quarters, you kind of tend to get it wrong at times. So what you do is you buy stocks with a long-term perspective and then you monitor them closely on a quarterly basis.
Have you exited something completely because the valuations or where your thesis got challenged? There are only 2 reasons why you would exit, right?
Yes, correct. So typically is the first case where the valuations go out of whack, and that is where you would want to sell some of your holdings. Otherwise, we typically very few cases, if you buy with significant margin of safety, it's unlikely that in the long run you're going to lose money. Short run, yes, things can always go worse than what you predicted, but long run, I think.
So what have you exited? I mean, where have you said that, okay, I like the company, but I don't like the valuations, or I don't like the way the earnings trajectory or the management vision has transpired. I invested in this company because of A, but instead of A, it's become a small A.
So to be honest with you, Nikunj, there's hardly anything that we have exited in the last 3.5 years. The portfolio from March 20 to now, we've gotten more flows and we've added new stocks, but we hardly exited anything in the last 3.5 years. Anything meaningful. Maybe we would have booked a little bit of profits here and there because our positions have increased significantly. Like something like an APAR has run up 10x in the last 18 months. So we might have booked a little bit of profits over there because the portfolio weightages have increased significantly. But besides that, as I said, from a structural perspective, we were invested in, say, capital goods or power sector or infrastructure or railways way before anyone else was even looking at those sectors. And we were invested because the valuations looked attractive. We invested in media 12, 15 months back. At that point in time, nobody was looking at media sector. So kind of our vision is longer and we're willing to ride a multi-year wave rather than move in and out of stocks quickly.
That's the other thing. It's not always about questioning how much the company can grow. It's also that, the stock may have run ahead of itself. Do you sense that that could have played out somewhere in railways, or are you still sticking by with all your positions?
So a lot of these sectors, Aisha, haven't seen any capital investments or any capital allocation for the last 8 to 10 years. It's not that it's not a discretionary spend for us. Capital goods is concerned. I stay 15 minutes away from my office, and the signal practically drops 4 times when I'm making a phone call on my way home, right? So you look at the infrastructure, you look at the number of cars that are getting sold, right? The automobile sector had a record month last month. So you need more roads. You look at the airfares. They've gone through the roof. So you need more investments, whether it is hotels, whether it is railways, whether it is defense. All these things, they're no longer discretionary spends. It is a need of the hour if you want to grow at 7-8% GDP.
Yeah, get your point. Hopefully it happens sooner than later. But good to chat with you as always, Siddharth.
Thank you. Thanks a lot. Thanks.
Okay, let's just revisit what the market as well has settled in at. While we were definitely seeing some amount of green, let's see whether it's managed to hold on or not. Yep, we're still clinging on to 19,600. Adani Ports rebounding the maximum, 3% higher on that stock. The Tata Motors up 2%, M&M, Adani Enterprises, Coal India, Bharti and Maruti, which are actually leading. So the beaten down ones from yesterday are the ones which are leading today. That's largely infrastructure as well as autos. On that note, we're going to take a very quick break.
Thanks for staying on with us. That's the Nifty holding out by 0.5%. The entire cluster of Adani Group stocks as well are a buzz. For instance, the likes of an Adani Ports, Adani Wilmar, as well as Adani Enterprises. That entire bunch is holding out quite well. And when it comes to individual sectors, you are seeing resilience from the entire real estate pocket. And not just that, you've also got some of those PSU banks which are firing up. But let's find out what the outlook is when it comes to Vascon Engineers. Let's understand their capex plans, some of the new order wins and margin outlook as well from R. Vasudevan Murthy, who's the Chairman Emeritus at Vascon Engineers. Good to have you on board. And in light of the fact that the company has won quite a few large orders in the past many days, can you give us a sense as to what is the breakup on your order execution and your margin profile?
Good morning. We have got about, compared to last year, we have increased our order book by about 60%, from 2,500 crores to about 4,000 crores. The order book predominantly is spread in government orders, predominantly in the hospital sector. We have a lot of hospitals to build, more than 5 hospitals. Then we have private jobs as well. So the order books is quite strong. And we do have the execution capabilities of doing more than 1,000 crores, which we have demonstrated before itself. And we intend ramping up this. In the next year, we should do more than 20-25% of what we did this year.
Okay. Where is the visibility essentially coming from? Could you be more specific about it?
About which ones?
The orders. I mean, where are you getting this kind of confidence that order book is strong and will remain strong?
See, order books are predominantly from the northern side states, We have from Chhattisgarh, from UP, from Jharkhand, all these locations, as well as we have some in South as well. So it's a spread across the country, I would say, both West, South, and North. The present order book strength is from the North.
Now, how much of the order book which you have currently is dependent on pure state? And given that there are elections which are there in, let's say, state of Chhattisgarh and Madhya Pradesh, could that have an impact on your receivables as well as order flows?
See, these are infrastructure projects where the governments have funded them. So the funding part, we have already checked with them that these have been already taken care of. Yes, during the peak of elections, there would be some, slowdown where could happen, which we are not sure of at this point of time. But normally, that's why our order books is usually, I'd say, 3 times the orders which we carry out in a year. So it takes care of that excess order book, takes care of the float which we do. So suppose we have 4,000 crores of order book, then we in the year we will be doing about 1,200 to 1,400 crore only. So that that additional float takes care of that variance, if at all in any of these states it happens.
So you don't expect that the state election will have an impact on any of your existing order book, because that sometimes has become a risk factor for many of the capital good companies.
See, it can always happen in business. I'm not ruling out that possibility. But these are, as I said, infrastructure projects, deep-based projects. Hospitals are focused as an expansion. This is an election agenda as well. So we don't anticipate problems in this particular sector.
Okay, fair enough. Give us a sense as to what the outlook is on the non-core business as well, because the GMP Technical Solutions business, you were looking to divest it. What is the status of the plan? What kind of a valuation are you currently looking at?
See, GMP this year would be doing, last year they did about 150 crores. We have an 85%, it's 85% holding in the company. It's primarily doing clean rooms for both pharma and semiconductor industries. The growth is very good. This year we are targeting to touch 300 crores from GMP alone. So the growth rate in this is very good. And since it's a specialized business, margins are also improving. As far as the exit from this is concerned, we're looking at purely on base of opportunity. If we get a good valuation, and if it is a strategic partner or if it is a takeover, we are open to looking at it. We are not, because it's not a core business for us, but it's not something like we would exit at any price. So at a good valuation, we would definitely look at an exit.
Right. Mr. Murthy, you also have a huge land parcel of 90 acres in Thane in partnership, as I understand. What do you plan to do with it? Do you plan to develop it?
So at this point of time, this land is huge land. We have, it is fragmented land. We are making efforts to get all the clearances required in terms of legal clearances required. In between, we had kept it on hold because of our liquidity situation. Since we are in a better position today, we have revived it. There are also a lot of activities happening around the land. There are a lot of warehouses coming with a lot of potential of residential coming there. So now is the time for us to consolidate this holding, and that's what we are doing. So we are making the land, trying to make it contiguous and making efforts to fill up the gaps wherever possible. And these are the efforts which we are looking at present.
So the promoter holding has come down from 32%, and in the company, and 28% of that is pledged. That's a very high proportion of promoter holding which is pledged. Why is that?
The holding has not come down from beginning. It has only been keeping growing. If you see, the pledge of 28% is 28% of 32%. It was required for the company when the company was not as good as what it was today, to be pledged by the banks as an additional collateral, which we had done. Now we're in talks with the banks to release it. It's not my personal pledge. It's a pledge for the company.
Percent of 32%. This is not 28% of total 32%, right? So this is 28% of 32%.
Yeah, correct.
So approximately 1/4 of the promoter holding is pledged, in which you think that you will be able to unpledge it by the year end.
Yeah. As I said, this pledge is done for the company's sake, and it is not that individual that I have pledged the shares for my benefit. And it was a collateral requirement at that point of time, since our situation was little tight at that point of time, and we banks had negotiated with us to pledge those additional as collateral, though we did have collateral with them, and prices were low at that point of time. Now things have improved, our ratings have improved, everything has improved, our share prices have improved. So in our reassessment now, which is going on for higher limits, this is one of the conditions which we are negotiating with the bank.
Right. Okay, Mr. Murthy, great to have you on the show. Thank you so much for taking the time out and joining.
Thank you. Thank you.
Let's take a very quick break on that note, but don't go anywhere. When we come back, we're going to be discussing autos with Horma Sarabji.
For staying on with us, just let's mark some of those real estate stocks: Phoenix Mills, Godrej Properties, DLF, Oberoi Realty, Prestige Estates. Put your finger on any of these names, and they're rising high and fast in today's trading session. Supportive of the market right now. We're up about 0.5%. Just flag off some of those names on your screen. Other than that, you've got the likes of Adani Enterprises, Tata Motors, Maruti, as well as ICICI Bank, Kotak Bank, and Bajaj Auto in the green. All right, speaking of real estate, let's hear out some top fundamental ideas from Sanjeev Bhasin and what he's looking at.
Godrej Consumer, by the way, was even guided on a better quarterly result than most other FMCG players. And I think Godrej Properties there will stand out. It would be the holding company of Godrej Industry, which is still undervalued compared to what their holdings are. And as this progresses, we'll see more color on that. But as a disclosure, Godrej Consumer and Godrej Property both are under our coverage. We own those stocks in our relative client portfolios. And we think that, just the pedigree of the group, Godrej Property, as you know, is now, I think, arguably the largest player pan-India, owning one of the largest land banks in Vikhroli. And Godrej Consumer has been arguably the best wealth creator in the last 3 years on the FMCG side. Godrej Industry would be a very key pay to buy, because you get a sum of parts of all the holding companies, and a holding company discount is fairly reasonable to buy into. We own PB Fintech, we own Zomato, and we own Paytm. We have not got into Nykaa, given the extent of competition and margins being slightly on the lower side. But all those three stocks are under our coverage. We think PB Fintech can be a true outperformer along with Paytm. And given the underlying business, I think the overhang of most of SoftBank's holding is over with. Same is the case with Paytm, and Financial was a big key holder. They are now less than 10%. And I think that given the extent of the business updates and how these have become part of everyone's lifestyle, Paytm and PB Fintech both can be very, very strong players in the coming couple of years.
Okay, some interesting stock ideas there coming in from none other than Sanjeev Bhasin. Today, of course, the recovery is led by the likes of, an Adani Ports, Adani Enterprises. In fact, all the group Adani names are the ones which are actually holding out. And, just taking a leaf, Nikunj, from what the CLSA report as well said about Adani Ports, that geographically, where the clashes between Israel and Hamas are happening is far removed from where the Haifa port is. So it's not really going to be such material damage for Adani Ports.
Okay, worst case scenario, there is a disruption. While CLSA is saying that the war is happening in the geographically, it's very different. But worst case scenario, there's a disruption. So then you look at what could be the financial impact. So then you look at the sum of part, because this is not the only asset of Adani Port. Yeah. Adani Port has a lot of other assets also, and their mainstay actually is India. So according to CLSA, the sum of part for Adani Port Hazifa port is about 2%, less than 2%. So even if there is a bit of a disruption there, which could be temporary in nature, but you assume that also that for FY25 you may not, FY24 rest of the year you may not get any revenue, then that's less than 2%. The stock had already fallen 5% yesterday, and that is something which markets had already baked in. But on top of that, what you also have to realize is that this is a cash generating machinery. This is a business where debt and balance sheet is not a challenge. This is a business where growth is only going to pick up as India will grow in terms of the import needs, in terms of their export, meter moving higher. So markets, the short term, they will always react, overreact, and sometimes there would be knee-jerk reaction. And what happened to the stock of Adani Port yesterday, in my book actually, was more like a knee-jerk reaction. And if you add up the numbers in a sense are indicating that the Monday sell-off in Adani Ports was not fundamentally warranted.
Yeah, and you're seeing quite the rebound coming in on that particular stock. In fact, just earlier today, Sanjeev Bhasin as well was making the point that if there is any weakness in Adani Ports, that should be looked at as a great buying opportunity. In fact, he's also bullish on Ambuja Cements from amongst the group companies. But here's Vetri Subramaniam telling us what he's liking in the market.
I always worry about valuations because, we've seen this before when stocks do extremely well and they put up the valuations. What are they actually doing? They are actually discounting the earnings that, these companies can deliver in the future. And if you pull too much of that into the valuation, you actually depress your forward returns. So, that's my concern when we look at things like some of these manufacturing themes. Now, there could be one or two companies which still manage to pull it off. But when I see a generalized tendency for the whole sort of sector or an array of companies to start discounting a very rosy future, this to my mind has always been a precursor to the fact that future returns have been pulled into the present, and therefore the future returns actually get compromised. And those high valuations, go back, look at infrastructure 2007, even go back and look at how the IT sector was trading in 2020, 2021, when everybody said the whole world is tech. Look at the valuations they got, and then it's been a gradual descent down in terms of valuations. So that's my concern when we talk about this manufacturing opportunity. It may play out in the economy. I worry that the stock market has discounted it way too early. This is an area with multiple companies, all globally competitive in their right. We certainly like that area. But, my approach toward this would actually come back to something you said earlier. I'd wait for those dips because these stocks having coming to up to 52-week highs is actually, to my mind, not making it to be a particularly attractive entry opportunity. My sense is that the macro commentary out of the US will continue to remain slightly challenged, particularly because our companies have a big exposure to the banking and financial services sector. And, if bad news comes along, I'll be happy if the stocks dip to go in and buy them. So long term, these are a brilliant set of companies, but I'd like to have valuation comfort before I get into them. So large banks have been disappointing, but I do think the top 5 or 6 lending institutions in this country, their incremental market share is now close to almost 2/3 of incremental deposits and loans. And I think that's the place I would be very happy to back.
All right, now, festival season around the corner. It's going to be Dussehra, followed by Diwali. It's that time of the year where everybody wants to know that if they're planning to buy a new car, should they wait it out, or are they likely to be greeted with fat discount? So festival season is that time when sales are likely to bump up. Auto companies are also stocking up the inventory. But interestingly, the change post-COVID has been that Indians are buying now SUVs. And sedans are selling, but they're selling less. Sedan inventory levels are high, and discounting there is something which could be the talking point, at least for this festival season. So what should the customer expect from auto companies in this festival season? Discount schemes or perhaps delays, because 2021 it was delays, semiconductor problem. 2022 the same problem. 2023, will it be delays, will it be discounts, or nothing? Hormuz joins us now. Let's connect with him to understand that what should be the expectation for the Indian new car buyer. Good morning, thank you for joining us. So what should a new car buyer expect to hear from auto companies this festival season?
I think, there are going to be discounts, there are going to be waiting lists. It's become more model specific. Certain models which are in high demand, the supply is low. Obviously, they'll continue to have long waiting lists. Classic ones of these are the hybrid versions of both Maruti and Toyota, the strong hybrid versions. Clearly, that is still the waiting lists are long. Certain models, let's say of Mahindra, the XUV 700, again, has some sort of a waiting list. But I think overall the inventories have gone up, waiting lists have come down, and we are seeing discounts in the market already not creeping in. Or let's say there'll be many more as we go into the festive season. So I think it's a good time to buy. There will be fair amount of discounting available. You've got a lot of the, let's say, the mainstream compact SUVs, which there's a lot of competition there, so good discounts to be had there. I think, you've had the, let's say, something like a Brezza, where you've got a good 30,000-40,000 off, maybe even more. You've got it across the board. You've got even with the Volkswagen Skodas, you've got some, let's say, discounts over there. And I think it's really the compact SUV and the SUV segments which are super crowded, where you're going to see a lot of discounts.
My second question is about SUVs specifically. Do you think that entire momentum of shift from sedan towards SUV, that will be an ongoing feature, or discounts and this fat discount between a sedan and SUV may just make sedan suddenly look attractive?
No, I think what's happening is that the sedan segment, it doesn't have as much intense competition as the SUV segment, but then the sedan segment isn't growing either. So even the existing players, and the very few of them, they're also going to be under pressure, and they're going to be discounting as well. So I don't think sedans can escape, let's say, the discount phenomenon, or because I think purely because the demand for sedans isn't growing at all, as I said. So I think it's going to be discounts across the board, across these mainstream products. As I said, it's just a handful of models which are still having some sort of a waiting list. But I think overall, good time for the car buyer, to shop around. And let's not forget that, what we've seen post-COVID, car prices have gone up. They've shot through the roof, and eye-wateringly so. So it's really, discounts is something which I'm sure the consumer would welcome.
Okay. Auto companies, Hormoz, at least when we spoke to Maruti, when we spoke to others, they said the following to us. We are right now stocking up inventory levels because we are confident of festival demand. Now there is the assumption and there is a bit of a hope here. What do you think will be the reality? Will auto companies be surprised, or will they be shocked?
So I think, there is still a fair amount of momentum, I feel. We've not seen, the demand has been there, the growth has been there. And I think we're going to see that momentum spill over well into the festive season. Of course, the appetite for, getting a new car has, I think post-COVID, it's become back on top of everyone's priority list. So, buying a new car is something which is very, very aspirational still right now. But again, intrinsically, everyone wants the best deal possible. And when they start sniffing that there are discounts available, they're going to push hard for that, maybe even defer a purchase if they are not getting that discount. But I think overall, the momentum is there. I think we should have another cracker of a festive season.
In light of these big discounts from Maruti, and like you rightly said, it's pretty much across the stable, right? Everything from a Celerio to Brezza. There's some steep discounts that are awaited this month itself. Who's winning the race when it comes to urban SUVs? We were just chatting before you came online that any car that you see on road, you barely see any sedans. It's only urban SUVs across the board.
Yeah, that's right. So I think right now, Maruti is claiming leadership just because it's got, certain key models. They even clubbing the Fronx as an SUV, where it's more of a crossover as a hatchover on still. So really the lines are blurred as to what is an SUV and what is not. So everything has been SUV-fied, so to speak. You're going to see next year Citroen coming out with a sedan that looks like an SUV. So, nothing escapes, getting the SUV treatment. And you can understand that because obviously SUVs have a certain appeal especially in India. Not only do they have better road presence, they have a higher ground clearance, which is super important. Roads, especially in urban city, you've got speed breakers, potholes, all that sort of thing. So I think that's where the SUV with the high stance really works. And I think that way it's just what the market wants. They just want these high riding vehicles, and SUVs have a certain road presence. And that's why everyone's making more of them. So again, as you say, who's got the leadership? It's really, you just have to add. I think right now, Maruti is claiming leadership, and as I said, it's because they are clubbing certain vehicles as SUVs, and kind of saying that they are the number one in that segment.
We have you here with us. Let's get some reviews going as well. So much focus on EVs. What is it that you would, peg as some of the top preferences? There's lots coming out from M&M, Tata Motors stable as well. You have the Hyundai Ioniq, etc.
So I think, in the mass segment, really, Tata Motors has moved the game forward with its new Nexon EV. Clearly, the XUV 400, which was Mahindra's first launch into this segment, been a bit of an embarrassment. But, this is just the start of a war. They've got a lot more in their stable coming out. XUV 400 was, let's say, a troubled kind of a product. It had a lot of history of how it was developed. Slightly a battery which they'd gone with LG, which wasn't optimal just because of the chemistry of the battery. They had issues in producing it, so a lot of challenges over them. Fundamentally, it's not a bad product, it's a good product. It's just that the Nexon offers so much more, and now with the facelift, there's just it's a no-brainer that it's the better one of the two. Though on its own, XUV 400 not bad, and as we've seen, huge discounts on the XUV 400 as well. So I mean, I suspect it was a little rushed to meet the CAFE targets, so that's why to offset the CAFE penalties which EVs do. But I think going forward next year, I think 25 is when we will really see the real challenge to Tata Motors, when Maruti launches, and Maruti and Toyota launch their first mass SUV at the end of 24, which might go on sale in Jan 25. Before that, you talked about Hyundai Ioniq 5. To me, that today is the best SUV in the market for the price. It is expensive, 50 lakhs, but it offers what more than what luxury brands, the luxury German brands offer. So I think clearly, there's a lot of good technology out there. Koreans are going to be a very formidable force. So I think, Tata Motors has had a good run, and we have to just see how they hang on to that lead. It'll be tough, but they've done an outstanding job to kind of grab this space for the last 4 years.
Sure. Hormaz, if you could just repeat yourself, which one did you say from the Maruti Toyota stable, which is going to be a big competition to Tata Motors?
It is this, the concept is EVX. It's an SUV. It's going to be a mass SUV. That is going to be really, really competitive, because 50% of that production is going to go internationally. So really, it's a global product that's being launched here, and for India, it'll be at an Indian price. It'll be very, very localized. Maruti does things fantastically on a scale. So I think this is really one to watch out for. And from what I see from the specifications, it's really superb. Very light vehicle, about just 1,700 kilos. It's got a 2,700 wheelbase. So it's really going to be. I think that's the one to watch out for. And I'm quite confident that that car will really kind of might even upset the current order.
Interesting. But Hormaz, given the consumption and the consumer patterns, it seems that the uppermost end, the luxury end, is where all the numbers are coming in. From real estate to watches, it's premiumization that the Indian consumer is moving towards. In the premium most segment, which are some of the top two cars? And I'm guessing it would be sedans.
Yeah, so I think, it would be sedans. And I think next year is going to be a very, very interesting sedan war, where you have the new E-Class, which has reigned supreme in long wheelbase form. They're getting the next generation one. But BMW are playing their same game and launching the 5 Series in long wheelbase. So right now, the E-Class for Mercedes is absolutely their bread and butter model. So they're really going to spec it and make sure that, it's very, very competitive and stays competitive. And BMW are coming in on their turf with a 5 Series long wheelbase. So for me, that's going to be the action next year, but it's going to be towards the second half of the year. But otherwise, I think Mercedes is doing an outstanding job, though their cars are getting expensive. But, the brand is so strong, and the tech they put in, the features they put in, it's clearly a case of, today consumers, especially at the top end, they don't mind spending more if they see value in it. It's no longer a price issue as it once used to be.
Hormaz, good to have you on board, giving us your reviews, your take, and your all-round expertise on the auto sector. All right, just let's quickly address the markets then. And at 19,600, you've got the broader markets, which are in fine fettle. Just a handful of stocks in the red, but otherwise comfortable gains for the likes of M&M, ONGC, SBI, ITC, Titan, and of course, the Adani group of stocks. Time for chart busters then. So let's find out what's on our chartist radar. Naresh and Kunal joining right back in. And no surprises, Kunal, that I see a real estate stock on your radar given what the sector is up to today.
Well, yes, Avan. So it's DLF, something which we picked up in the morning on the the opening segment, and the reason for picking up DLF is the stock coming out of a consolidation over here. So the charts over the last 5-6 months for DLF has been very attractive from this major base formation, which the stock had shown around the 350 odd mark towards a rising support, which the recent support for the stock, which was around 450 levels. Now, interestingly, in both of these trend consolidations, we've seen that whenever the stock has given a breakout of the previous swing high, this previous swing high has actually become a base or a support for the next breakout trend. So this resistance around 520 odd mark, 515 odd mark for DLF acted as a strong support over here in this leg of correction for the stock, and now it's seeing a breakout for itself. So importantly is this breakout candle, which you can see for DLF, is a very strong thrusting breakout candle. This indicates that the stock is restarting a strong uptrend for itself. So something which started off maybe something like in the mid stages in the month of April and May for the stock, when we had seen such a kind of a strong candlestick pattern and then a follow through up move for the next couple of months. I'm expecting something similar for DLF from current levels of 550. So would look out for targets of at least 600 over the very near term.
All right. Meantime, let's move on and find out what exactly Naresh has got on his radar. Naresh, is it real estate or something else?
So it's a banking stock, that is IndusInd Bank. Now, after making this trending move from 1,000 odd levels towards 1,400, 1,450 levels, the stock for the last 3 months has got into a tighter range, is making higher bottoms. So no more in the fall is it seeing a deeper cut. And slowly and steadily, there have been 4 higher bottoms. But on the upside, 1450, 1470 has been attempted multiple times in this period. Shorter term, over the last 3 sessions, when the markets have corrected, the stock has actually shown a lot of relative strength. So out here, eventually, it seems like finally it could set up for that breakout above 1450, 1470 levels. So a buy at current levels, preempting the possible breakout going forward. Stop loss at 1390 and a target price of 1550 to 1700.
Let's take some stock strategies as well, Naresh.
So first is the buy on Coal India, continues to be in a strong trend. Stop loss at 285, target price of 310. Second is a buy on DLF, hitting fresh 52-week high, strong momentum out here. Stop loss at 540, target price of 580.
What's on your list?
Havells is the first stock which I would suggest as a buy. The stock is heading towards a breakout of the 1400 mark, so 1450 as a target. Stop loss at 1360. And second would be a buy on Bajaj Auto. The stock is also at the cusp of a major support point. So 5200 as the target. Stop loss at 4970.
Okay, on that note, let's take a very quick break. Come right